Hey guys, Doug the Retirement Guy here. Got another great video for you. Before we get into that, first I want to thank each and every one of you for watching. Hey, if you like what we're doing, give us that thumbs up. Don't miss any of our videos. Hit that subscribe. And best of all, if you have any comments you like what we're doing or don't like what we're doing, hit us that comment. Everything's going to help that channel grow, and we are growing by leaps and bounds. Let's get into today's video. We have 4 bond funds that will keep you safe in the downtimes. It's paying a 6.75 dividend on average, and it pays it monthly. Plus, this is the big one. They're growing their dividends by 12.17%. That is unheard of. This is going to help your retirement account grow and your income grow, and we're going to show you today. The goal of adding to a retirement account is fairly simple. The number one thing you want to do, you want your investments to give you some growth. So you want things to be going up. The second part is you want income from your investments. So you want that money to be paid to you on a regular basis that you can live off of, and you want to relax and be worry free. You don't want to be worrying about anything. You want to be spending your time on the beach. So the goal of adding bonds to a retirement account is very simple. One, no roller coaster ride. You're not going to have a fund that's going to go way up and then drop off like a roller coaster. You're not going to climb the big hill and then drop off to a lower bottom. The next thing is bonds go up when interest rates go down. We're at a point right now that interest rates are flattened out, and they're going to have to start to come down in a short period of time. So bond rates are going to start going up. Your yields are going to go up, which means you're going to generate more income. And ultimately, the relax and be worry free, it's smooth sailing because the bonds just continue to produce your dividends, your returns. It's like having a reverse credit card, I tell people. You have a credit card that has a balance onto it. Instead of paying every month, paying a minimum payment and interest tacked onto it, it's reverse. They are paying you a minimum payment and you're getting the interest. Let's take a look at our best bond picks that we have found while we're doing our research. The first bond has a positive upside of 0.45%. Now, this is, again, these are not going to be outrageous upsides on the price of the fund because remember, we don't have the roller coaster hill climbing up. What we do have, though, is the pot of gold that we have is 6.10 yield of a dividend that's paid monthly. And the big one is 1.68% growth in the dividend every year. Our second bond, and this one we love the best, has a 1.28% upside, has a 6.67% yield paid monthly, and a 7.94% growth in its dividend alone. This thing is rocketing, getting it to where it wants to where it really needs to be. And this thing is going to see a 7 to 8% dividend payout and just continually cranking out money. Our third bond shows a zero, basically we call a downside. It's flat, it's not going up, it's not going down. Pays a 6.44% yield and a 1% growth in its bonds. And then finally, our fourth one, again, 0%, but has already a 7.77% yield and a 1.55% growth on their dividend. So you take a look at this, your dividend and your yield or your dividend are both growing at inflationary rates. So as a total, we're looking at about a 1.73% growth over the next 12 months, an average payout of 6.75 dividend paid monthly, and a 12.17% growth of our dividend total. Our first bond fund is the JPMorgan Income ETF, which we call JPIE. Now, the nice thing about this one, it has a yield that pays 5.93%. 60% of the bonds are investment grade. Now, what is investment grade? Pretty much everything rated in what they call A class, AAA, A plus, AA. These are all low-level credit risk or very low-level credit risk across the board. You can also add into this is the BBB level, is the bottom rock that you can be at to be classified as investment grade. When we look at the dividend chart that JPMorgan has done, it's amazing that each one of these are paying the average 21 cents per payment per month on every share that you own. Now it has an annual payout of $2.73 already, and it's already projected to grow by 1.68% of their dividend. And you can see this as they switched from July to January, the increase that they had there. And you'll continue to see this increase. Now, if you want more information about the JPMorgan JPIE dividend, we have every one of these on a separate, longer video that goes deeper into what they invest into and what they do. We'll leave those in the description below if you want to find out more about any one of the specific bond funds. Now, if you look at the JPMorgan Income and look at the price of the stock, that's what this chart is here, is how the stock has done over the time. The average price is $45.76. The current price is $45.82. So that's already 0.01% above average. Okay? The highest price point of $46.07 to the lowest was $45.68. This is showing you the drop off in the March Madness and the April tariffs, which you see at the very end of this bar chart, where it dropped from its peak all the way down to rock bottom. And now it's funny, in only 24 days, it's already back up to almost to its peak level. So it's already dropped and recovered. This is the unique thing with bonds. The drop off was very minute and the recovery is extremely fast. Our next bond is Angel Oak Income, CARY. Now this fund pays a 6.6% yield monthly. 50% of its bonds are A-rated or higher, which again, as you see, very, very low risk. And we pay out an annual $1.36 annual payment. Now here's the exciting part of this one. They're already projected to grow by 7.94% on their dividend payments. If you look at their track history, they're basically paying almost 9 cents per month on a fairly what we call base level. But you see where they had a big jump in January up to 20 cents. That means they're getting a lot more funds in, and they have to pay out a special dividend to clear the board. So instead of doing big giant ones, they're expecting to raise this thing up 7%. So you can see on this one here, Angel Oaks, this is the price of their stock that's gone all the way through. Their average price is $20.78 over a 52-week average. Their current price of $20.68, basically you're at 3/4 of a percentage point below the average price. So there's already an upside of just getting back to average. Now the other big thing, the highest price point that this had was $20.81 in the March and April sell-off. The lowest it got to was $20.62, which is basically a 0.9% drop-off. Now you take a look at this chart all the way through, it's coming right back. There is no real drop-off. They are just rebalancing themselves when other stocks were dropping 10 to 16%. This fund went nowhere. It stayed flat and stayed balanced. So the positive here is your money stayed at the same value it was, but you continue to collect your dividend. Our next bond is iShares Flexible Income Active ETF. This one pays that 6.44% yield, pays it monthly. 50% of their bonds, again, are A-rated and higher. And it pays a $3.37 annual dividend currently. You look at that dividend chart, extremely steady, 23.6 cents per share per month. And you see it does have some spikes, that there are some big spikes that they do pay bonus size payments. So again, very, very solid yield, solid dollar amount per share. Now we take a look at what did the share price happen here. Right now, the average 52-week price is $52.48. The current price of $52.04, which basically gives it a 0.08 percentage points difference between the two. The recovery was in 30 days. The highest point it had was 52.46. The lowest point was 51.87. So it had a 1.1% drop off in the March and April changeover. And we can see that again in this chart at the bottom. But look at what it did. In less than 30 days, this thing has rocketed right back up to that $52.04 price, right where we expect it to be. So there is a slight 40-cent increase that we could see continuously, but getting back on track. So roller coasters, non-existent. Yeah, we had this drop off, but again, this drop off is so minute compared to what you've seen with regular stocks at 10 to 16%. Very clear part. Our final bond is Spider Profile High Dividend, High Yield Bond ETF, SPHY. Now this one here pays a 7.7% yield and pays it monthly. Now, you ask, how does this one pay a little higher dividend than others? 84% of their bonds are B or higher rated. Remember, when you drop down from A's into the B's, the interest rates will go higher. The risk slowly rises. Now, don't let that panic you, because if you get a good mix between A's and B's, you can get a nice yield, but still have the security and safety. I highly suggest, if you were really interested in this one, click on our other video of SPHY and get the full details of what the fund will do. We put this down here, as you can see, moderate, substantial, and then high risk is in the single B's. But when you take a look at their big mix of their 84% from B and higher, they are really keeping it safe for you. It pays $1.81 annually. You can see up here it pays 14.8 cents per share per month, and it's been doing this for quite a while. This fund is over 10 years old, and you can see the dividend track history that they have just continued with a nice steady growth and keeping it well balanced with a few spikes up and back down to normal, paying you some bonuses. They have an average 1.55% growth rate per year of their dividend. So this thing will just continue to grow each and every year. We take a look at the stock price. How did it do over time? Well, first off, it's again 52-week average, $23.52. The current price of $23.26. That is basically 0.9% below that 52-week average. So it's like having a little bit of a stock on sale to pick up a little bit of gain. And here's the one I watched. The highest point that it got into in that March and April time frame was a $23.6 price, dropped down to $22.40. Now that was a 5% drop. And again, I know you've heard me say this over and over again, when the stock market was dropping 10 to 15%. This is our biggest drop off that we've seen in any of the bond funds. And that's because of them being more into those B's category, that people start to say, ooh, a little higher risk. They dropped off to it. But the best part of it all is in 20 days, they've recovered everything that they had. They came back strong, which is the same thing I tell everybody is, was this sell-off, was this drop man-made, or is there a business practice error? And when you look at this fund, there is no business practice errors. This is just was the scare of the markets with tariffs and so on coming in, and that's why this thing recovered in 20 days. Now, in summary of our account, 1, the investment growth. We had no roller coasters because we had no real drop-offs. Everything that we showed you that in the March and April timeframes have dropped off has come back. The dollar amount investment, we're at 6.75 monthly dividends. So basically, you can relax and be worry-free that if you had $100,000 set aside in bonds, you'd be collecting $6,750. That's only $100,000, guys. Now here's the big thing. Don't forget, you have a growth of the dividends of 12% across the board with these 4 funds. So when you sit back and look at a 12% growth in your dividends, you're going to have some huge dividend payments down the road. Guys, it's Doug, the Retirement Guy. I hope you liked the video. Give us that thumbs up. Don't miss any of our videos again. Hit that subscribe and leave any comments that you have down below. Everything helps the channel grow.